Well, good afternoon, good evening, everyone. I still see we have a lot of attendees signing in, but good for all of you to be here and canceling your plans once again to join us. Very excited to bring you this episode, our sixth episode here for the Presidio Perspective. So again, I'm Dustin TenBroeck, your presenter for the day. I am joining here momentarily by Ken Chambers from PIMCO. And we have a good episode here for you today. So I'm going to go ahead and share my screen. Hopefully everyone can see that. So again, just want to make sure so introducing our guest here momentarily, we have Ken Chambers. He's a chartered financial analyst and senior vice president and strategist for PIMCO, a name most of you know, especially for my Orange County constituents there. So he is part of the multi-sector fixed income team headquartered in the Newport Beach office for PIMCO. Is an MBA from the Booth School of Business, University of Chicago. So looking forward to bringing Ken on. I'm sure it's not always top of the headlines that you read or the news channels you tune into. I mean, there's a lot of focus there on the stock market and economy, of course. Not always big headlines about what's going on in the bond market, but it's obviously a very important part of your portfolio and something that we want to tune into and be tuned into. So we look forward to hearing Ken's perspective on things. For those of you who knew, I know we have a number of you. This is your first time joining our webcast series. So this is our sixth episode. Since this pandemic kind of surfaced here 6 weeks ago and the market started to go into free fall, we wanted to make sure we were on the front lines communicating with you on a weekly basis, talking about what we see, what we're looking at, what changes are going on in portfolios and what we're doing and kind of action that we're planning to take as we go through this. So, here at Presidio Capital Management, we are your personal CFOs, your fiduciaries to help advise you in all facets of your financial lives. So a focus, of course, on the markets and investment management here in this webcast. So, always our disclaimer. So all investing involves some kind of risk. In fact, it's mostly what we talk about in this webcast. So everybody should have a good understanding of that and just know that we're not giving anybody here any specific tax, legal, or investment advice. So make sure you consult your own personal attorneys, accounting professionals, and financial advisors to make your own personal decisions. So a little update on COVID-19, just, since the last week that we've talked, and depending on how tuned in you are to the news outlets, it's been progressing pretty rapidly. So, our deaths reported by coronavirus here in the U.S. has eclipsed 45,000. It's actually almost 48,000 as of right now. And so that number has doubled in just about 1 week. Shocking right now. If you look at the numbers in the state of New York, that 1 in 1,000 people in the state of New York have died from this disease. 1 in 700 people living in New York City have died from this disease. If you think about just the United States population in general, 1 in 7,500 US citizens has died from this disease thus far. So, we've obviously been talking about this a lot as these episodes have played on, and we can't underscore, how significant this is enough. I mean, it's just, we hear a lot of information out there, or I do personally, in our communities, as well as on the news outlets, listening to one of the CEOs this morning, kind of downplaying the disease and saying that maybe this is overblown and it's not that deadly. And, there's a lot more people that have this case that aren't reported. And so the death toll isn't maybe as high as what we're expecting. But, I just think you're hard pressed to go and look, 50,000 American families in the face and say that it's not that serious or it's not that deadly. I mean, yesterday was a pretty deadly day. We had over 2,800 deaths in just on April 21st of 2020. And I mean, that's more than what we had in the Twin Towers in 9/11. I mean, that was April 21st. And that is happening each and every day as we go through this. And so, we know that we're still in the thick of this thing. And, we're hoping for a brighter light at the end of the tunnel, so to speak, and for those days ahead. But it's certainly, it's weighing on us pretty heavy right now of what we're going through. And if you do the math, again, I mean, of just how many new cases we are seeing every day that are reported, so if you're one of those that say there's a lot more that are unreported and the numbers aren't justified, well, we know that there's 25 to 30,000 reported cases every day. And out of the reported cases, about 5.5% of the reported cases have resulted in death. And, so in a week, out of the reported cases that we're having, we're talking about accruing about 10,000 American lives lost every week during this disease. So a lot of focus has been on reopening of the U.S. economy, kind of getting back to normal, and when can we go out? And there's protests here in San Diego and Southern California to open the beaches. And by the way, San Diego had an uptick in cases. The last reported day was 2 days ago. We had 109 new cases, which was about double of the previous days. So, we still see that there's a long road ahead, unfortunately. And if you look, throughout the world, Beijing City was one of the first to get hit with this disease and, took measures to reopen the economy. They were forced to make, gyms and those kinds of events and venues close down because they started to have an uptick in cases. So, we're very concerned about and focused on, the ability for us to keep a second wave at bay. And we just haven't seen anything like that work yet to date. Robert Redfield, who we quoted last week, again, is telling us, there's a possibility that the assault of the virus on our nation next winter will actually be even more difficult than the one we just went through. And this was, as of yesterday, reported on CNBC. So, I just wanted to start today with a very uplifting message, obviously, but, to put this in perspective, we have seen a big kind of relief rally in the stock market, and a lot of the conversations have been about reopening the economy. And so we just kind of want to pause and take a look at what's really going on. And we question, how close we might be to that and how permanent that reopening is going to be. So far to date, we see it as a very temporary measure that we might get to enjoy. Although I'm sure we're all looking forward to it at however short it might be. Again, we talk about the big three, with Presidio and our planning. The inflation, taxes, market crashes are always the three things that we want to focus on. It's what we can focus on to help preserve and protect your wealth. I mean, these are the three biggest critical issues facing your financial plan. All of these want to make your money worth 30, 40% less, and they will, given the wrong strategy. So, let's kind of go through these three, because these are always what's top of our mind and what we're looking at, and how we're going to make changes. So, the first one, of course, is inflation, and something that we're probably not going to see right now, but something that absolutely households and investors are going to have to prepare for in the future. In the short term, obviously, we're not seeing a lot of inflation. In fact, information came out from March just recently this week, and inflation numbers are down a lot lower than what was being projected, obviously. And so there's a lot of things that go into there that we're not going to report higher inflation numbers. So obviously no one's really flying anywhere right now. If you wanted to fly, it's pretty cheap, but the TSA is reporting there's a 94% decline in traffic through the TSA line. So I fantasize about a nice smooth TSA line and a cheap ticket, but who wants to go anywhere? Hotel occupancy is down 70% year over year. Rooms are really cheap, but no one's taking advantage, right? And we can't. We're all asked to stay in our homes and do what we can. Even retail clothing outlets saw a 2% decrease in clothing and accessory prices in March. So, during this time, you're not going to see rampant inflation in the early days of a recession, obviously, for a number of reasons, but especially with this disease. I mean, and you've seen the price of the gas station, I'm sure. I'm joking. Of course we haven't. Who's filling up their tank at the gas station? I mean, I think I filled up my tank once in the last month, and I think I still have 7/8 of a tank left. So, But on that note, you might have heard, what happened with oil prices earlier this week. So, here's a little chart of oil declining from 2018, April of 2018. And we're just going to play this and watch what happens as we get into 2020. And actually what happened for the May contracts, as you might know, is oil went negative. So producers for those May contracts were theoretically having to pay to get rid of their oil because we are running out of storage for oil. There's massive amounts of supply and there is virtually zero demand for oil and oil-related products. And of course, those kinds of things we see in a recession, but certainly not to this degree. And I mean, this is one might argue a sign of what you might see in other industries. Certainly there's a lot of things to play in the energy market, but supply and demand economics are true in all the different industries, and there's a lot less demand. So, we think that when you look at energy prices, airline tickets, hotels, housing, there's a lot of decrease in prices. So in the short term, we don't see a lot of inflation. Now, there is a lot of fiscal stimulus, right? And so we've talked about this in prior episodes where, the printing machines are essentially on with the Treasury and the Fed with their asset purchase programs and bailout packages for small businesses and households. There's a lot of money being injected into the economy. And I think the hope on Wall Street is that's going to replace a lot of the lost earnings and a lot of the capital lost in the drawdown in the stock market. So certainly at some point, all that additional money in our system will likely make its way into purchasing goods and services. But I think, and again, we don't know, no one has a crystal ball, and certainly I don't. But I would argue that there's a strong likelihood that the velocity of that money finding its place into purchasing goods and services or building factories and hiring people and buying equipment, et cetera, is going to be likely pretty slow. And I think about several conversations I've had over the last week, and not to mention, hundreds, if not thousands over my career with many of you. Some of you think about, have you ever talked about how you were a Depression era baby, or your parents went through the Great Depression or grandparents went through the Great Depression, and think about the psychological impact that had on generations of people. And you think about the roaring 20s where employment was high, assets were growing, money was easy, and all of a sudden it was ripped away and it took a very long time to get back. And that event had a lasting impression on this country for generations. In fact, many of you tuning in today have admitted to me that your financial decisions and the brain that you use to make financial decisions have been directly impacted by something that happened 90 years ago to a different set of people. So, we can talk about how healthy the economy was 2 to 3 months ago and what things were like. However, what emerges from this is going to be something completely different. And there's no models that the stock market can use or economists can use to see how CEOs and households are going to feel about things in the future. But I would argue that it's likely going to be pretty different than today. I believe that, we quoted a statistic last week that, I think it was somewhere around 70% of US households had less than $1,000 of savings. And of course, after the last week or two, you can be sure that that's down to a negative. I guess it's still less than 1,000. But, so how are CEOs who virtually ran their companies with no savings accounts, no reserves? How do households that had very little reserves emerge from this when things do get back? And how quickly are they going to want to spend that money versus build that cushion? So we see, for a number of reasons, the velocity of this money that the government is putting into the economy, which is absolutely necessary in our view. We're we're in support of that, it could take a while, and that could slow down the speed of the recovery, but it also will keep inflation at bay, right? When that confidence comes back for the U.S. consumer to start moving that money through the economy, that's when you see a real new kind of renaissance when we come out of the other side of this recession and bear market. But make no mistake, we're in the very early stages of this, and which I'll get to here in a minute. So we see that inflation is something that maybe not an immediate concern, but certainly it's on our eye for something we're going to have to deal with in the future. Taxes, of course, are a big one, and something that's always on our mind, or usually around this time, April 22nd. We're all thinking about the check we wrote a week ago, but you have a little bit more time this year, as they extended the tax deadline to July 15th. But, so if we think about tax rates in the future, we can likely see, hey, Ken, all right. So we can likely see, one could argue an increase in taxation down the road. I mean, for a number of reasons. So first, it's probably not lost on anybody that we've had some massive government spending. In fact, it's a little creepy or eerie to think about. We are, in some sense, kind of operating in this socialistic communist society right now in this country, as everybody is kind of waiting at home for their check from the government. Whether that's directly through the relief provided to U.S. households, or whether through the PPP loan where the government pays the employer and the employers pay the people, or whatever bailouts are on the way. I mean, that's what we've kind of seen in these times. So, there's lots and lots of government spending that's happening in a time. So you have, if you think of the U.S. government as a household, they're spending like crazy. And how is the income that they're used to coming in? Well, historically, how the government gets money is through tax revenue. Well, if you have people unemployed, if you're not going to have a lot of personal income taxes, if people are making less at their jobs, their tax rates and amount of taxes that they're paying are going down. Home values go down in a recession. You have less property taxes. Corporate profits are less. You might not have any corporate taxes being paid. So, we're going to be through this period where there's a lot of spending and very little income. So again, what we see on the other side of that is there are only two ways to address that debt issue is by making it worth less through inflation, or having to pay it down little by little through higher taxation. So these are future issues that we want to keep on the forefront of our mind, because there might be things that we want to do with our portfolio today that is going to help prepare us. So we've talked about taking advantage of Roth conversions. Maybe you have some capital gains built up or losses you want to harvest. So making sure you're doing the right things from a tax strategy in a bear market is an opportune time to have that reviewed. But still, of course, our largest concern of the big three is market crashes. And we experienced a drawdown already this year. We've had, quite a recovery from that low already. We'd like to put that in perspective with you tonight, but still, threatening the risk of your capital out of these three, this is, of course, the more immediate concern and something that we want to make sure we have solutions for. So, in our first episode, we went over with you the historical study since 1950 that there had been 9 of these, bear markets since 1950. Okay, so there had been 9 of these significant drawdowns in equity prices. 2 of those were associated with a flu out of China. So, we have some lens in the history books that we can look at, and we know that if you look at those 9 different bear markets, they have had an average drawdown of 36% from peak to trough. If you look at the S&P 500, it took about 15 months on average to get there. So from the stock market high to the low took over a year on average. And it took over 2 years, almost 2.5 years, just to get back to even from that low period. So, typically these events don't last for 30 days, 60 days on average. They've been a lot longer. If we look at those 9 bear markets and we look at how many of those were coupled with a recession, we found 6 of them. So we have 6 bear market recessions, which we believe we're experiencing today, that we can kind of look into the history books and say, what should we prepare for as investors? And so if you look at all these different ones throughout history, we, on average, again, the drawdown, 21 months. Then takes 35 months, almost 3 years after you've you're done watching your statements go down, on average 3 years to get back to just where they were before that crisis. So on average, bear market recessions to get back to where we were at the height of the stock market is almost 5 years. And so again, no bear market's the exact same, no recession's the same. I mean, the economics is a relatively new philosophy or science. It's been around for about 100 years. And every time we go through one of these events, we learn something new of what to do next time, right? And so we apply our learnings from the past. So we learn something new each time. And of course, so none of them are going to look the same. But we know on average, we should prepare for a pretty long time. So what are we looking at here? The drawdown 1 month. Anyway, so we're just preparing for a much longer experience that we're having right now, and again, we look to the Oracle of Omaha. Again, I've shared this with you before, that we simply attempt to be fearful when others are greedy and greedy when others are fearful. Okay. And so when you see this elation in the markets and everything recovering and we're going to open up the economy and this is all past us, we just see so much data that is contrary to that. And I'm not saying it's not possible, but certainly as capital managers, we want to make sure that we are pointing out and viewing the risks to capital, and that drawdown is still very much there. So again, our asset allocation is going to be paramount to weathering the storm and for creating buying opportunities. I mean, we believe cash is king. It's going to be for a number of years, despite what private equity managers like to say about it. But, we see that there's a lot of volatility ahead, a lot of unknown. So as events transpire and new data comes out, you're going to see a lot of green days and a lot of red days. And if you've been watching, that's what you've been seeing. So, today we're going to want to talk a little bit about the bond section of this asset allocation with our guest speaker, Ken, today, who I'll turn it over here to in a second. We're going to hear his views and PIMCO's views on the current economy, the crisis, what they're looking at for opportunities. So Ken, are you with me?
I'm here. Can you hear me, Dustin?
I can.
Great.
All right. We're glad to have you. So I can stop the screen share and just put you on the slide. So, hey, thanks for joining us. Glad you got the technology all figured out there.
This is really exploiting my lack of youthfulness, figuring out Zoom. My wife is way better at it, and she had to come help me a little bit here.
Well, good. Thank her for us, but we're glad we can have you. So I'll let you take it away.
Yeah, thanks for having me and really appreciate the opportunity. I think, hearing everything that you just talked about, very consistent in terms of how we think about things. And as long-term investors like PIMCO is in terms of how we're managing capital, obviously we have different types of strategies that have different objectives and warrant different type of risk profiles. But at the end of the day, thinking about managing money over multiple years, the long-term perspective, you want to take advantage of buying opportunities when they present themselves, but there is a fiduciary component to this of you can't simply just pile into risk assets just because it looks like things are getting better, because this situation is with coronavirus is just extremely unique. The uncertainty around the path of the virus, the longevity of the virus, and a lot of the news that we're starting to hear over the last couple of days for the potential repeat and even more devastating news come this fall and into the winter time really makes this a challenging environment to think about short-term capabilities for corporations to generate cash flows, as well as longer-term capabilities to generate cash flows. As an investor, whether you're on the equity side or the fixed income side, what you care about is valuations and fundamentals. Fundamentals are essentially rolling up your sleeves, figuring out what that company is doing to generate cash. How are they doing it? Are they doing it well? Are they doing it efficiently, both in the short run and on the long run? Fuller picture, are they investing in their company well enough, doing enough R&D? Are they making sure that they're priced appropriately? In the short run, you got to think about your competitive market space. And right now, given the fact that we are facing an uncertainty as it relates to the coronavirus, and the best remedy that we have so far is to have everyone stay at home, which clearly from a humanitarian perspective is the right thing to do. And it's really nice to see that so many people are stepping up to the plate to do that. but from an economic perspective, is creating a somewhat destructive landscape, especially here in the US. When you think about the US economy, 70 to 75% of the growth or GDP from this country comes from good old consumption. The idea of going out, buying a TV, buying a car, spending money at the grocery store, which we're all doing to an extent, but not to the same degree that we have been. So at a very quick snapshot level, when we look at things like PMIs, the manufacturing sector, on a global basis, and obviously this started in China and has started to make its way through other economies, you have seen just overall economic output growth numbers already begin to decline in a very serious way. And PIMCO's estimate is obviously for Q2, the quarter that we're in now, to be the most severe, for this to actually persist into the third quarter. And then really at that point, because so much stimulus has been given in to the system, because there will likely be reopening measures, that's when we're looking for growth from a GDP perspective to start to pick up. We at PIMCO have been talking about this idea of a U-shaped recovery. I think people have always thought like V-shape, you go down really quickly and then you rebound really fast. Or there's the dreaded L, basically you go down and then you slowly start to make your way up. Think almost like I guess the Nike swoosh logo. That would be more of an L. We do think that you're going to have a U recovery for a couple of different reasons. One, the economy was doing fairly well entering this period. It wasn't gangbuster growth by any means. We weren't talking 5, 6, 7% growth, but it was, I would say, a robust 2 to 2.5% growth, which is pretty good considering we had been in the longest expansion period since World War II. So things were firing pretty well. Unemployment was extremely low, and it get back to that idea that 75% of the US economy is driven by consumption. If people have jobs, if people have paychecks, that really allows you to continue to progress in terms of overall growth. Obviously, we know that we are faced with a bit of a hiccup, but the measures that have been taken both on the fiscal side, so Washington really getting their act together, stepping up to the plate, passing a bill, passing another bill, and already having talks of another bill that's going to be needed. So these multiple phases from the fiscal side is something that from our perspective as asset managers, we think is ultimately not only a good thing from a human perspective to make sure that you're taking care of the people that need something at this time, but also just the fact that you naturally are looking to heal the economy. The other big thing is obviously what's happened on the monetary side. And the Federal Reserve, along with pretty much every other global central bank, has either cut interest rates or taken some type of accommodative measures to try to stimulate growth. And if you think about what designed to do to be that lender of last resort, to aid in these types of situations, they have certainly done that. They've dusted off a lot of the playbook from 2008, things that were haggled over for various reasons, one or another, for over a couple of week time period back in 2008. They were able to quickly enact this time around by backstopping things like the money market industry, by backstopping commercial paper facility, putting in different types of facilities to target corporate lending. So by doing this in the way that I think about it, firefighters, we're up in Orange County, when they're chasing wildfires, trying to put these wildfires out, they put these brakes in, right? Circuit breakers. Don't let the fire jump over to this part. That's essentially what these facilities are designed to do. And then now the Fed can start to inject liquidity to normalize things so that once the system is allowed to essentially walk or run on its own, you're basically through this period. So think of what the Fed is doing is trying to build that bridge to get the economy to the other side. You're going to see their balance sheet increase, just like it did during 2008. The natural question is going to come, okay, so where's the inflation? When's it going to come? And Chairman Powell, actually, the head of the Federal Reserve at this time, he got that exact question during his press conference not too long ago. And even after 2008, and you think about all the stimulus, if you remember, we had QE1, QE2, Operation Twist, QE3. There was 4 or 5 different operations sequenced over multiple years to stimulate the growth in the economy. And still, inflation was significantly below the Federal Reserve's target, which is 2% on the PCE measure, which equates to about 2.3, 2.4 on what we often all look at, the CPI measure. And Chairman Bernanke, former Chairman Bernanke, who was head of the Fed at that time, he's actually an advisor for PIMCO. And when we've talked to him a lot about inflation, inflation is something that the Fed obviously targets from their objective. Fed's objective is to have full employment in the US and price stability. So you could easily argue that they were at the full employment prior to coronavirus. They weren't hitting necessarily on their inflation target, although things were moving in the right direction, but still below target. We do think that the inflation is one thing that the Fed is going to continue to welcome. So almost keeping pedal to the metal, making sure recovery, and then deal with the inflation when it comes is somewhat of the measure that we feel like the Federal Reserve is likely to take on a go forward basis. And by all measures, and even looking at 2008, you can ultimately expect that to be multiple years down the road. As long-term investors like we are, this is a time that we will oftentimes buy a bit of insurance via what are Treasury inflation protected securities, and we'll layer those into our portfolios today. Somewhat of that idea of, you buy insurance when it's cheap, not when the fire's at your front door. So we'll do that within our own strategies, but that is naturally the one thing that most people think about of some of the measures that are being taken. Is it the right approach? The other thing is obviously the moral hazard component, and the idea that, things are being bailed out. And this is where I think the environment today, there's a lot of similarities between this crisis and 2008. Predominantly because of the response by the fiscal and monetary authorities, but there's a couple of distinct differences. And the reason why in 2008, a lot of people raised the moral hazard problem was the idea that 2008 was very much a banking crisis. It was a crisis that started in the banks that were essentially being bad actors, and it emulated into the real economy. This type of situation from an economist standpoint, they would say, this is exogenous. This happened outside of the economic system and made its way into it. So starting to an extent in the real economy and now making its way into the financial sector. The reason why that matters is because the financial sector, the banks specifically, are in a much better place today from capital ratios, coverage ratios, and just their overall business models. So the remedy, the obviously response from the monetary authorities, the quote unquote bailout to an extent, it is actually helping those that need it more so in the real economy. That's where you've seen things like PPP, the protection for paychecks, and you've also seen a lot of loans towards small business to, again, build that bridge to get people to the other side, not necessarily bailing out one banking institution versus another. That's where this thing is a little bit different. And something that Dustin actually touched on that is also distinctly different and really can't go unsaid is the coronavirus situation. While it started in China at the beginning of this year, for the most part, I would say on a global basis, it really started to impact markets in late February and ripped through the month of March. So there was about a 3 to 4 week period where you saw the destruction in financial markets, the drawdown. As you highlighted in terms of previous recessionary or drawdown type periods, those typically last a year. So we experienced everything within a 3 to 4 week time period. As a fixed income investor, you are earning your interest, your coupons along the way. You are receiving maturity payments. These are things that help offset any of these types of price declines. So as a fixed income shop and a fixed income person, we haven't been able to earn our interest along the way. So you might open up your statement and see, wow, my fixed income bond didn't do as well as I thought it would do. Partly because everyone took it on the chin, basically right out of the gate. But over time, you will naturally see fixed income securities recover. But at the same time, certain bond funds, ones that are very core oriented, I would say, things that have duration, that are sensitive to interest rates, those actually strategies did quite well and did what they're supposed to do, offsetting the equity part of an overall portfolio. So it all comes back to this idea of having a balanced approach, making sure that you're in line with your overall objectives, thinking about where you can go on offense, now isn't in time that you can certainly say there's the potential for another drawdown from here. We are certainly not out of the woods. Even the idea of going back to the office here in California, we've gotten no guidance on when that will happen. We do have essential personnel going in, so our portfolio managers, we've spread them out all over the different floors to try to keep everyone safe. But I think that where everyone is shifting their focus now is, this is somewhat of a new normal for an undisclosed period of time. So how are we thinking about reopening? What does that look like? How are the stages happening? And even, where is it happening? And how will that lead to economic growth? Because, being in California, I could say in having office, we have an office in Austin, Texas. I can probably safely say that our Austin, Texas office will open faster than our California office. And both those offices will likely open before our New York City office. So that gets to that idea of the reopening is going to be sequenced, which will lead to growth, just slowly healing over time, barring any type of vaccine that comes through, testing programs that come through. And I think from an asset manager perspective, that's what we're truly focused on. Thinking about what type of developments we can get as it relates to the virus. And until then, figuring out from a corporation, the companies that we invest in, understanding their ability to generate cash flows, access liquidity, and essentially survive in this time period, but also do things to make sure that they're there in the long run. And that's where, from a fixed income perspective, there is a lot that you can do in terms of the management that we talk to, understanding the business models, understanding people's access to liquidity, because there's a couple things that you always know as a fixed income investor. You know what your interest is due to you, and you know when you're going to receive your principal or your maturity payment. So long as you hold that bond until maturity, you're entitled to those two things. And it's really just weighing different decisions, weighing the relative value of owning one bond versus another, and building a portfolio that what we try to do, thinking it from this is our base case. We don't have a crystal ball. How can we hedge different types of risks that are out there in the world to make sure that we're building portfolios that are somewhat resilient? And in today's environment, that essentially means you've basically seen price dislocation everywhere. You've seen prices decline dramatically because of uncertainty around coronavirus, but that doesn't mean you have cash flow dislocations. There's a lot of bonds that are backed by the government. There are a lot of bonds issued by tier one companies, household names that we still have a lot of confidence in. And those are the types of exposures that we certainly think about and try to build a core portfolio around, but then certainly play offense on what we would call bend but don't break type exposures. Securities that are a little bit more higher yielding in nature, where you're going to have them bend every now and then. They might take mark to market volatility, but at the end of the day, those cash flows are still resilient. So ultimately, that's what we're trying to do. We're thinking about where the path of the virus goes, how we're thinking about corporations and their ability to generate cash and invest in obviously high quality names.
Awesome. Thank you. Just wanted to follow up with a couple questions, and then, we'll open it up to any of you out there. So if you have any questions for Ken or myself, feel free to put them into the Q&A section there. We're happy to answer them. Could be based on anything we've talked about or anything else financially or COVID related that's on your mind, so long as we feel qualified to answer it. So Ken, I appreciate absolutely what you guys are focused on and what you're doing. Of course, us, with a key interest in PIMCO and your management team, and so want to listen always of what you guys are doing. So you talked about the differences between 2009 and 2008, 2009 financial crisis and what we're experiencing now. And how we had this, kind of everything thrown at us in this truncated period. We've never experienced anything like it. for 100 years anyway. And so, we'll see about reopening the economy and how quickly this comes back. I mean, what we've theorized in prior episodes and what's still heavy on our mind is, how long can this play out? I mean, is this, and in our view, it looks like this is probably get used to dealing with this for the next, 12 to 24 months, with an optimistic view of 3 to 6 months. We're not quite sure, but, going in and out of our homes might be something that we have to experience. And we've seen what, just 4 weeks of, shutting down the economy has taken its toll. So, are you at all concerned with, further shelter in place orders down the road later in this year into next year, having an effect on the economy to where, we've experienced the COVID related financial markets, but could we see something like we saw in 2008, 2009 on top of this? I mean, does this make its way into the financial system with, the oil market declines, people not able to afford their mortgages, how well capitalized our banks are now versus then is obviously very different. But, what's the risk there that we should be worried about or not?
I think, it's a good question, and it's unfortunately it's a hard one to answer because it's underpinned by the coronavirus and the uncertainty that it does bring, and that is the risk in the things that we try to weigh. So from an investment standpoint, we do continue to favor liquidity within our portfolios, simply because we're not in a trajectory to know that we're 100% on the mend and heading upwards. And the reason why that is exactly what you described, this idea that we are shelter in place for the foreseeable future. That foreseeable future could be a month, could be 2 months, it could be 2 years. Until we have adequate testing, until we have a vaccine, until we're comfortable as a society to go out and consume the way that we have, I think there will be economic destruction. One of the left tail, I guess, negative scenarios that we're obviously hopeful that does not happen, but could come to fruition. You have seen a tremendous amount of job loss. The initial jobless claims, and we're going to get another look tomorrow, has been significant, somewhat in line with expectations, but still, it's one thing to expect it. It's one thing when it actually happens. And that whole saying of a recession is when your neighbor, a depression is when you become unemployed at the same time. That's the type of environment that can be relatively, scary when it comes to a rebound of the economy, because there are certain jobs that you can imagine are not going to be coming back in the same fashion that they were just 3-4 months ago, especially if you think about some of the retail names that unfortunately had to furlough employees. That was a sector that was already facing tremendous stress in terms of the business model. You can certainly see certain corporations making changes and using this opportunity to restructure their business. So I would say the longer that the shelter in place lasts, the more likely that you are going to have some type of economic destruction, that you get back to this idea of the recovery. So we think it is a U, that you're going to go down, you're going to go along, and then you'll ultimately recover. The shape of the recovery is going to be dependent upon that reopening effort. And what we have heard from the presidential administration, from different governors, is it is going to be sequenced in nature. So the fact that it's not going to be, okay, we're all clear, time to go. And even if we do get a vaccine, I think there's still going to be hesitation in certain things like travel, hotels, cruises, that you're not going to see full economic impact coming back. So this is something that's definitely destroyed growth and will likely come back in a more, fashion that's just going to bounce around, a more volatile fashion. But in the full, what we can do is we can model cash flows, we can understand different business models, and we can try to invest according to what our fundamental research, because we think about fundamentals and we think about valuations. We can work on the fundamentals. Valuations, we have to look at what things are trading at in the marketplace today.
Okay, so yeah, and obviously a focus on liquidity and the fixed income world is key. And we're always looking at you guys to let us know when we're really out of these bad times. The fixed income specialists, it's said, are going to be the first ones to ring the alarm bells and kind of watch what you guys are doing to know how bad or good things are. So we have a keen interest in where you're positioning your portfolio. I also just wanted to kind of mention to the group out there, we've had a number of guest speakers and perhaps myself talk about, the government's balance sheet, the balance sheet increasing for the Fed and asset purchases. And, what does that mean? So can you kind of explain what it means when you say, the balance sheet's going to get larger and the Fed is buying assets? Can you kind of explain what they're doing?
Yeah. So there's two, I guess, one really important thing for the Federal Reserve is that they are independent. They are doing things to help them achieve their objective and their mandate. Their mandate is to have the U.S. Economy essentially be full employment and have price stability. They are supposed to take actions to ensure that that's ultimately what happens. What their actions look like is essentially deploying their balance sheet, buying assets at time, or potentially selling assets. And one of the primary ways that they deal is also is to move interest rates up and down. Obviously, to stimulate the economy, one of the best ways that they can do that is by lowering that policy rate. That should allow for credit creation, for us to be able to go buy cars at cheaper levels by borrowing things, by going and buying homes at cheaper levels. That is allowing them to stimulate growth. Another way for them to stimulate growth is essentially doing asset purchases. And this isn't something that started in 2008. This is something that they have done for quite some time. By going in and buying treasuries, by buying mortgages, they force out the average investor, the PIMCOs of the world to an extent, to go buy other types of things. And because of that, you will see those asset prices from a valuation perspective get really, really unattractive for us as we're looking to generate income. And then you'll see that actually we'll go buy other things. So ultimately, it's part of their tools in their tool chest that is available to stimulate growth.
Right. So you have holders of bond portfolios out there, that need to sell their bond for one reason or the other. And so when there's not a lot of buyers on the other side and you have a lot of sellers, supply and demand economics says that price is going to crater and go down. So the Fed is stepping in to be one of those buyers, right? To create that liquidity. So there's somebody to buy that, so that people feel confident into originating loans and investing in loans, and that they're not going to be left with nothing. Question on that, where does the government set its price point? I mean, so they're not just buying at par in a wrecked market, are they?
No, I mean, they are the buyer and the lender of last resort. And ultimately, when you think about what they're doing and buying it and holding it until it matures, it turns into a situation that they're basically going to allow that bond to run off. We'll often talk about it as the Fed's balance sheet is where bonds go to die. Basically, they're going to sit there and they're going to hold that bond until maturity. And from a fixed income perspective, what oftentimes that means is they're going to go buy bonds that are actually below par values today, because there's already been a shock to the system. And with that, you basically, they're buying an asset that's cheap, and they're going to allow it to mature over time. And you saw this happen in 2008 with the response that happened there. And that's actually, you saw the Fed actually do pretty well, and they return that money to the Treasury, because ultimately the Fed is funded by the Treasury and the US government. So they somewhat go hand in hand. But the reason why I came out with that idea that it's really important that, from an objective, independent perspective, you need the Fed to be independent and not basically backstopping the government from doing bad things that you have seen in other economies.
Right. And on that note, we had a question from the audience there. Do you think that these bridges, that we're talking about, and as you referred to with the stimulus package and the asset purchases, do you think it's enough of what you're seeing out there?
So that's a really good question. And I think, is it enough? Depends. And I think one thing, so we talk to the Fed a lot on a daily basis at this point.
Now you're talking like an economist kind of.
Yeah, I did go to the University of Chicago. Everything starts with "it depends." So basically, when we've talked to the Fed, when you look at their response, everything has been tailored to deal with the problem at hand, but also with this idea that there might need to be additional measures taken. One thing, every time we've talked to them, and we've talked to them every day for the last four weeks, it always deals with certain things, and they're not just talking to us; they're talking to all asset managers at this point. And it always comes back to okay, what else is needed? What do you need? What do you think needs to happen to make sure that liquidity comes back? And that's where the plans that are being put in place today are obviously being announced, but then they're being tailored and adjusted as they go. So the potential for new facilities, the potential for additional stimulus certainly is out there, because their job as the lender of last resort is to ensure that the bridge essentially is long enough to get us to the other side. And again, there are probably unintended consequences that will amount to or be the result of all this, but it's also one of the things of we'll cross that when we need to. It's really making sure that we get there and stave off any type of huge depressionary environment.
Yeah. Okay. Let's see, a question for you. What are your thoughts on the corporate debt and leverage ratios being pretty high? And then the dangers of bailing out those companies that have a lot of leverage versus those that do not. And do you think that those companies who've, have a stronger balance sheet or less debt are being hurt by the bailout of highly leveraged companies?
Yeah. So one of the new programs and facilities that the Federal Reserve announced this go around compared to 2008 is one that's targeting corporate bonds, both investment grade and potentially junks or high yield rated bonds. And I think the Fed, everyone believes it's not the Fed's job to pick winners and losers. However, by buying certain bonds, you're going to certainly help that company. Everyone always thinks about equity prices and trying to forecast if someone's going to go bankrupt. A fast way to look if they're going to go bankrupt is look at their bond prices, look at their borrowing costs. And if you have a lender of last resort like the Fed, if you have that buyer come in, that's going to push their bond prices higher. They can only buy up to 20% of total outstanding debt for any corporation. But that is where the Fed's programs are designed to provide liquidity, provide stability to the market. They're not trying to pick that winner or pick that loser. The credit market today is one that valuations were extremely tight. So the spread between what you get in the corporate bond relative to a treasury bond, that's the spread. It had been so tight leading into this. You saw that really reverse. Spreads widened dramatically as risk assets sold off. Partly, because they were almost overvalued. The valuations are still wide, but overall, there are certain corporations that we still have a positive view on. But there's a lot of corporations out there that you do have to think about their debt levels and their ability to service that debt and their ability to potentially term out that debt. You've started to see new companies issue debt that's starting to work, but ultimately, we as an active manager will say there's stuff that we can do from a research perspective. We can look under the hood. We can talk to the C-suite. We can model out their cash flows. And that's where it comes down to, if they have a lot of debt, it might not be great, but are they doing the right things with their debt? That's where ultimately it comes back to making sure the fundamentals match up.
I have a poll that I want to put out to the audience here in a second, and so I'm gonna do that. But before I do, I want to ask this, make sure I get this question in. How concerned are you with the municipal bond market being affected by this?
Yeah, speaking of alterations by the Fed, munis were not originally part of the Fed's ability on their money market facility and some of their other ones.
Didn't you hear, was it Mitch McConnell today saying he's in favor of, state bankruptcies?
Yeah. I think
specifically targeting California, Connecticut, and I think one other state.
I think the comments made there are seem very political in nature,
Sure.
which is unfortunate. This isn't a time that we want to see things politicized, but
Yeah.
but you know, don't let a crisis go to waste was started by someone in politics. So you're starting to see a little bit of that play back and forth. We are a huge muni investor, and we think about muni bonds, and you talked about this actually at the beginning in terms of things that you focus on. I'm pretty confident to say that, you know, taxes are likely to go up due to stuff that is happening right now. And at the end of the day, the best way to protect yourself from taxes is to own muni bonds. But obviously, making sure you own the right bonds that aren't going to go bankrupt is a crucial thing. But there's actually things that we do as an asset manager. So Puerto Rico are bonds that actually we bought in bankruptcy, and we were part of the restructuring committee. And we bought bonds that were, I think, 40 cents on the dollar that recovered all the way to like 90 cents. So there are headlines, and you will hear these things pop up, you know, every now and then. It wasn't too long ago, I believe it was Meredith Whitney, who went on 60 Minutes or something and said basically all municipalities are going to be going bankrupt in the next 12 months. That didn't happen. So again, it comes back to, you got to be able to understand the cash flows, their access to cash, and you know, hopefully you won't see things get into the political realm when clearly it's a time of need for a lot of folks.
Yeah, good. Thank you for touching on that. All right, I'm going to put a poll out to the group, and so I want to hear what your thoughts are on a couple questions. So one, when do you think we will return to normal? So just think of your own personal lives. What is your expectation right now? And I'm not asking you to forecast when we're going to be out of this, but you can log in your vote of how long is it going to be before you return to the gym, to movie theaters, to the beach, to our office, you know, all the places you want to be. And how do you feel about the current COVID restrictions? Do you think that they're about right? Do you think they need to go further? Do you think they've gone too far? So we'll go ahead and put in your responses there. Let's see. So I think we've touched upon the bridges, bailing out of the companies, what connects the economy with the stock market. I could talk about that again. We have a question. If you have anything to make out of Warren Buffett doing a debt raise for $2 billion in Japanese yen and what that means for the US dollar.
So, yeah, I just read that one. It's an interesting one. I haven't read that he did that. We see corporations do that on a pretty regular basis in terms of going and raising funds in different currencies, either based upon borrowing rates or based upon investments that you might have in those specific currencies. So it's hard to speculate why they would be doing that just off the bat. I could say from our view on the dollar, this is the type of environment that on a go forward basis, you would expect the dollar to somewhat weaken relative to a lot of different currencies, simply because of the fact that, one, interest rates are very, very low here. Deposit rates are dropping, and they're pushing a bunch of stimulus into the economy, which essentially devalues the dollar. What you saw last time is you saw an initial couple of years or so where the dollar did get devalued versus most major currencies, but it came ripping back a few years later. So it could be something that is unique to Buffett in yen terms that he needs to do, or it could be something that, you know, he's going to move that money around. It's a little hard to say though.
Okay, good. All right, let's share our results from our poll. So we had about 80-something% of the audience there respond. And so most of you look like you're prepared for the long run. You got no highly optimistic people thinking that we're 2 to 4 weeks away. I'm kind of glad to see that. A couple of you are more optimistic in the 1 to 2 month range, but most people kind of preparing for 6 months to beyond a year. So that's just what you kind of see out of around the 80 people who responded to this poll for your information. How do we feel about the current restrictions? Most of us are thinking it's about right. 10% of us think they haven't gone far enough, and about 20% of us think they've gone too far. So, it's interesting. Whenever we go through one of these things, we always look back and say, oh, I wish I did that. I wish I didn't do that. Ken, I'm sure you are like me. You have a story of what you wish you did on March 9th of 2009. I think about my highly intelligent attorney telling me to buy Bitcoin in 2010, and doing the math and how many zeros that would have equaled to, so we always look back at these times and kind of say, what I wish I did, what I wish I didn't do. And so it'll be interesting to look back here and see what's, how right we were. And, there's a lot of mistakes being made for sure. And hopefully we're getting some things right, but, we're in it for the long haul. So Ken, appreciate you joining us here today. Thanks so much. It was great having you. Hopefully we can get you back. Appreciative of all the hard work you guys are doing at PIMCO. Always interested to what you guys have to say. So everybody else out there, thank you so much for joining us. Just remember, we're here to help you and serve you. If you need to get in touch with us, you can do so. Go to our website, presidiocm.com, or give us a call. On that tune of looking back of what you're going to regret or what you're not going to regret, I can tell you that if you poll probably 1 million people 12 months from now, you're not going to get a response that says, I really regret taking a look at my portfolio. I really regret creating my financial plan. I regret talking to a financial advisor. So I'm still hearing from people out there that they are waiting for this to blow over, to take a look at their portfolios. They're waiting for this to blow over before they schedule financial consultations with a certified financial planner. So, most of you out there aren't in this camp. If you are, might start wanting to look at the timeline of what it's going to take and think about, when you're going to look back at this, what you're going to wish you did and what you wish you didn't do. So, try to take advantage of the times here. We have all this great technology that allows us to communicate. So we've been doing that with most of you out there. So anyway, thank you guys. Ken, again, thank you. Everybody will tune in next week, Wednesday at 4:00 for episode 7. Stay safe. We'll talk to you next time. All the best.